Everyone thinks cheap stocks are just some beaten down penny stock that may never recover, and that's not what this video is about. Today I'm talking about three companies you probably use every single day, businesses that you trust and that quietly run life in the background, and right now the market is pricing them as if their best earnings are already behind them when they clearly are not. So these stocks are cheap because the market has been short-sighted, not because the businesses are broken, and the first one on my list has to go to Microsoft, currently trading at around $400 a share and down nearly 26% since October 28th. This is one of those stocks where the disconnect between perception and reality is getting absolutely extreme. And Microsoft's valuation over the last couple of months has compressed a lot. As we can see, the stock is now trading at a PE ratio of just around 25, which sounds pretty normal until you realize how much growth they have on the back end of the company. And you realize this is the same multiple that a company like Google, which is also in the Mag 7, traded out right before it had a massive re-rating once the AI monetization became very obvious and how they are beginning to grow. And unlike most AI stories, Microsoft isn't promising future revenue. It's already generating it. Microsoft's latest earnings were objectively good, beating on both ends of revenue and earnings per share. One of the main things I want to point out to you guys is the cloud growth. It held up very strong year over year. The margins have stayed absolutely strong in the six mid teens level. Guidance has not collapsed, but the stock didn't react the way people expected because the market is obsessed with one thing, and that is their Azure growth. But here's why I think this matters, because the numbers that I think that I plugged into my DCF model, I got a $616 base case for Microsoft, and this is my price target. And there are four key drivers that are going to drive this type of share return this year. First thing I'm seeing is the Azure cloud growth, which is obviously what we saw people were underestimating. But in Q2 fiscal 2026, Azure grew 38%, which is absolutely obviously great. And this is massive at this type of scale. The market's threshold is very simple. And I think that as long as Azure stays above 30% growth, Microsoft can support a much higher valuation and continue to grow. But below that, the multiple will compress, and above that, the stock will continue to re-rate and grow higher. Right now, Azure is comfortably above the line, and I want to see them continue to hit above 30%. Second is the AI Copilot revenue, which, as we can see here, the current status is paid Copilot seats of 15 million, generating 450 million in total seats. But I think that for them to grow, what it needs is adoption at scale. This doesn't need to be $1 trillion product overnight. But based on my estimates, I want to see this pretty much double year over year to generate roughly $11 billion in annual revenue. And this, I think, is very possible as they continue to grow quickly year over year. And the adoption rate has been growing. As we can see here, 3.3% adoption rate in 2025. And if we could get to 6.4, which is obviously very possible with how good the products are, how big the customer base is. I think that this is a definitely a possible thing to have. And given enterprise pricing, the bundling they're doing, and Copilot being embedded across things like Microsoft Word, Microsoft Excel, Outlook, Teams, I think that this number is very realistic as it is also getting implemented into more schools across the nation. I know it's personally at my university, so that is where I'm standing here. Third thing for me is the revenue growth. Fiscal 2026 revenue is expected to reach about $327 billion, which represents 16.4% growth year over year. And this is elite for a company of this size. And I think it is obviously possible, and I think it is even expected at this point with how well they've performed and how, I mean, it's pretty, you're probably listening to this on something that has, maybe if you're listening on PC, it's definitely has something to do with Windows on it. So this is elite growth, and I think they will continue to grow steadily. Fourth thing is also the OpenAI partnership, which we saw on their balance sheet, accounts for roughly 45% of Microsoft's $625 billion cloud backlog, which is obviously an absolutely massive thing. And that alone gives Microsoft long term pricing power in AI infrastructure. And if OpenAI ever goes public, which I'm pretty sure they were expecting to IPO this year with some big names like Discord, other big names as well, Microsoft has multiple ways to monetize that relationship beyond just cloud revenue. And none of this potential upside, I think, is fully priced into the share price right now. So the bottom line here is that you're buying a core piece of global technology infrastructure at a mid 20x multiple with accelerating AI driven revenue and multiple upside levers that the market is refusing inside their current models. And that's why I see Microsoft as a cheap company currently. Next up on the list has to be Reddit stock. This is probably a controversial pick, but this is a criminally misunderstood, underrated pick on my list. Ticker symbol RDDT, and they just reported their earnings, and the numbers were absurd. Yet the stock is down nearly 50% since September. So when we look at the numbers, the growth is not slowing down at all. Revenue came in at $726 million, which is absolutely huge and up 70% year over year. That's actually faster than the third quarter, which showed 68% growth. Another thing I want to point out to you guys is the daily active users grew very quickly year over year. And this is a main thing that I'm seeing here is that this is completely kills the bears narrative that Reddit's growth has stalled. As we could see here, 19% year over year growth, which is obviously huge, especially in the international market, which is what I want to point out to you guys, especially with this stock, because Reddit already reaches 15% of the US population, but only less than 1% of the global population. Of course, as US growth will slow, international I see is the real opportunity, and it is just starting to get started here. As we could see, 142 million, but it is increasing at a faster rate than the US revenue, and it will continue to drive what we see in the future, in my opinion. Another thing I want to point out is the average revenue per user, which is increasing very quickly, up 42% year over year. Yes, quarter four is always the strongest advertising quarter for companies with Christmas, Thanksgiving, all that stuff going on. So you don't need to overthink these types of comparisons too much. But what matters is the profitability we're seeing from this, especially. And incremental net income margins came in at around 60%. Here we can see 58%. And this is absolutely strong growth. And that means that for every additional dollar of revenue, Reddit keeps about 60 cents, which is elite for a company at this size and that is continuing to grow. And another thing that really shocked me with the earnings report that came out was their guidance that they gave. Reddit guided for $595 million to $605 million in revenue and $210 million to $220 million in EBITDA for quarter one. Historically, Reddit has always underguided on their earnings. This suggests 50% plus growth could still be on the table for 2026, which I think is definitely not priced into the stock, especially after it has dropped so much over the last couple of days. Another thing to be mindful of that the Reddit has just had a big buyback, and it is why the stock is really down, I think, the most. They approved a 1 billion share buyback, and people are pretty mad about it. And this makes no sense to me because Reddit doesn't need the capex to grow. It doesn't need to invest in capex like other companies need to grow their AI or anything. But this company, it's an asset light business that is already printing a lot of cash. So buying back shares at this level is exactly what disciplined management should be doing and what they are doing, which is why I am personally bullish on the company. With the current market cap, the company sits at around $26.5 billion, which is, I think, absurd because if revenue grows 50% in 2026, which was my bull scenario, 50% growth, and the net income margins settle around 40 to 50%, which leads to a 1 billion to 1.1 billion in net income, then this stock will fall into a PE ratio of about 22 to 25x, which is insane for the type of growth that they're pulling in. And even in a disaster scenario where revenue only grows 30%, which is what I projected at the worst case, Reddit could still generate $730 million in net income, implying about a 33x forward earnings, which is obviously insane for a company growing this fast with this much visibility. I find this to be an extremely cheap company, and especially after this recent opportunity. So That's where I'm at with this. Last stock on the list is Amazon, beaten down all year long. We thought earnings would be decent. Nope. We always get hit with something. So Amazon sold off because of one headline pretty much over the last couple days, and that is that there was $200 billion in AI capex spend, which is the biggest of any of the Mag 7 companies. It is absolutely blowing all the other companies out of the water, and people saw the spending and ignored the return that is going to get. And as we know, AWS is the real story behind Amazon. So AWS remains the engine behind Amazon's valuation, and demand for AI computing is exploding. So the problem isn't demand, it's actually capacity. And Amazon is spending now to make sure it owns the pipes later and it owns the infrastructure later. So obviously the margins will take a hit in the short term, but I think long term the free cash flow will expand absolutely massively over the next coming years. So this is where I am parking my money. I will definitely be investing more and more in Amazon, especially once it's still at this $180 to $200 range, which it's been at for a couple years, and I've always accumulated at these levels. So next thing I want to point out is that the retail margins are improving very quickly due to automation, the logistics optimization, and third-party seller services. So I think that this is going to be a great year for Amazon, and I think it will obviously be an expensive one as well, but it will set them up for a big jump in the stock price in the future. So I'm looking to be buying in the $180 to $190 range, currently trading a little bit higher, but I think it is very opportune, especially with how big their ad business alone is. So this is a massive profit driver. As we could see here, revenue reached 21.3 billion in Q4 2025, up 22% year over year, and ending the year $69 billion in total revenue, which is absolutely insane. And the main thing I'm seeing here is that the market hates uncertainty and big numbers when they're involved in that. So every time Amazon has invested aggressively, the market complained, and every time long-term shareholders were rewarded by buying the dip on these types of stocks. And this is not a next quarter stock. This is not a 3-year cash flow story. I might be buying after next earnings. I'm not sure yet. We'll see how the stock moves. Currently at 210. I was telling you guys 190 is my target, but thank you guys for watching. I want to hear your guys' thoughts in the comments. Drop a like, drop a sub. I've been sick a couple of days, so I haven't been uploading as much. I hope you guys have a great Super Bowl, though, if you guys are watching in the U.S. Be safe, guys. Have a good day. Thank you. Peace.